go to our conversation with Girish Pai, Head Institutional Research, BOB Capital Markets. And emphasis, persistent, Coforge leading the recovery makes sense, the mid-cap IT companies. Girish, very good morning to you. Let's start with your take on the Accenture numbers and what it's telling us about how Indian IT companies could perform this quarter.
Yeah, thanks for having me on the show. So I think optically, when you look at the guidance increase that has happened, so if you look at the organic growth guidance, that's been up by about 50 basis points from the previous quarter. Previous quarter, the number was 2.5% growth YOY in organic growth terms. This quarter, that was raised to 3%. So optically, things look good. But when you do the math on how things are going to play out in the second half of the fiscal, and the fiscal is between, it's an August year-end company. You have organic growth going from 4.5% in 2Q, which is the quarter that's just gone by, to 0.5% growth in the fourth quarter. So there's a fairly significant deceleration that's kind of happening here. And the second half of Accenture actually coincides with the first half of FY26 of the Indian companies. So if you ask me, is it relevant from an Indian context perspective? What's the read-through? To some extent, yes. The point here, the major point is that my sense is the deceleration is largely driven by the DOGE factor. US government is 8% of the total revenues of the company and probably the largest customer. There is also an element of uncertainty-driven cuts that have happened because of the general uncertainty in the macro environment, the demand environment, which is what the company talked about. But there was no specific split between the two, the DOGE element and the normal business environment related issues and stuff like that. So my sense is that if you look at the Indian IT companies, there's been the stocks have come off quite a bit from their peaks in the recent past. That has been because there was expectation that FY26 is going to be far stronger year compared to FY25 with what's happening on tariffs, on DOGE and such other things. People have kind of lowered those numbers. We are talking about a growth very similar to FY25. The question is it going to stop there or is it going to kind of decelerate even from there?
Okay, so I think a couple of things that are important, and one of them definitely that perhaps what you're seeing in Accenture is largely a problem of how dependent they are on federal government orders. It's not a problem Indian IT companies have. But in terms of demand and discretionary demand, that trend still continues, isn't it, Girish? Is that still a concern from our perspective, Indian IT company perspective?
So discretionary spend commentary of Accenture has been far more muted compared to the Indian IT services companies. Indian IT service companies have been saying that there are green shoots on discretionary spend, especially in certain areas of the market. BFSI North America has been one that's been called out for multiple quarters now, driving discretionary spend. There have been certain companies like TCS and Infosys who've called out BFSI Europe, some have called out retail, some have called out high tech. So there have been other verticals who kind of joined the party. So discretionary spend commentary of Accenture has been far more muted than that of the Indian IT services companies. The commentary coming out from Accenture has been that the focus has been on driving cost efficiency, cost takeout projects. The projects are larger, the deals are larger. And there, from whatever I can gather from the deal momentum, it seems to be kind of gaining market share vis-a-vis the Indian players.
Okay. Girish, morning. Neeraj here. It's been a really long time and great to have you. So when you look at, let's say, Accenture commentary and the dichotomy between Accenture and Indian IT and what could be happening with this whole AI development and the impact, or for that matter, Citigroup saying that they are going out and reducing contract workers and going to hire their own workers. What does that make you feel about the current cycle of IT? You've seen various. Is this very similar to the past ones wherein there is fear, but it will get bought into, or could this time be different?
So we do have macro-driven slowdowns that we've seen in the past. Maybe this is somewhat similar to that. I mean, the way tariffs are kind of playing out and the uncertainty surrounding it could be one factor which is kind of playing on the minds of customers, which is driving slower spending. So we'll have to wait and watch how this whole thing around the tariff situation on April 2nd, reciprocal tariff, how that's going to play out. I think the other thing that's very important from a US economy standpoint. Again, we're going back to macro because the headlines have been hogged by the tariff situation. Is the fiscal consolidation that the Trump administration is attempting in the US. The view has been that the Biden administration has been going out and spending quite a lot. Now they want to rein in the spending. The current run rate on fiscal deficit in the US in FY25 is about 2.7 trillion is the fiscal deficit. The budgeted number is 1.9 trillion. So in my opinion, there's going to be significant fiscal spending pullback in the next 7 months, which is going to impact various sectors in the US. And obviously there's going to be second order impact on the Indian companies. So already we've seen airlines in the US saying that government travel has kind of been cut back significantly. And some of those are customers of Indian companies. So there could be the second order impact. It's not so much the direct impact from a DOGE perspective. It'll be the second order impact. Now coming back to growth, my sense is that people have been expecting high single digit, double digit kind of growth. I think we're going to go back to a normalcy kind of a situation where my sense is that the Indian IT service industry will grow in the mid-single digit territory. 5 to 6% kind of CAGR is a kind of number that I'm looking at. Maybe there could be a one year, we'll probably see a spike in growth, maybe going up to high single digits. Maybe it could be a FY27, it could be a FY28, one doesn't know. But those are things that one needs to watch out for. But my sense is that tier one IT companies will grow in that 5-6% territory on a constant currency basis from here on. Because if you look back in history, they are like twice as large as what they used to be 10 years back. And FY15, they grew about 7% between FY15 and FY20.
Got it. Okay. So, Girish, I'm still trying to get a shortened sense. Do you think this will get bought into, or is it difficult to call that right now? This weakness.
So again, I go back to that point I made that FY26 doesn't look like it's going to be a better year than FY25. Maybe at best it could be similar. The question is whether we're going to see cuts from here, whether we're going to see a weaker year in FY26 and how weak it is going to be. That is a point that needs to be watched out for. Now, is it going to be just an FY26 phenomenon? Could this continue to FY27? That's the other question that investors need to ask themselves. Because even my numbers, we are assuming that FY26 is going to be weak, but things will pick up in FY27. So we've seen three years in succession where growth has been weak for the industry. Could we have a fourth year in FY27? That is a question up in the air. And again, we don't know whether FY26 is going to be weaker than what current expectations are. So I wouldn't think we've seen the worst. We'll probably have to wait and see how this DOGE is going to play out, how the reciprocal tariff situation is going to play out. So things are ahead of us in one sense.
Fair enough, Girish, but all things considered, and here let's come to what you're liking. Would you say your mid-cap IT players are better positioned? They're also leading the recovery that we've seen today coincidentally. Or would you like your 3 or 4 big ones that are always in focus, your ITC, your TCS, Wipro, Infosys of the world?
So tier 2 companies have been growing faster than the tier 1 companies. They've been gaining market share. Surely one, because of size, I think they've been managed better, they've been executing better. But having said that, until some time back, they were trading at 50, 55, 60 times forward. I'm talking the top 1 or 2 companies. So I think at 55, 60 times forward, I think they've priced in quite a lot. If you bought at those kind of levels, you wouldn't make any kind of serious money. Even if you held on to them for like 5, 10 years, is my opinion. So you'll probably get mediocre returns. So yes, they will grow faster than the tier 1 companies. Tier 1 companies, as I said, will grow in that 5-6% territory in constant currency terms. Maybe the tier 2 will grow 7-8% percentage points faster than the tier 1s over a 5-7 year time frame. But having said that, the valuations still, I think, are not there as yet. I think valuations have to come off even from current levels. So today, if you ask me, what would I prefer? I would probably prefer tier 1 versus tier 2, even at this point in time.
There, Girish, on the pecking order?
Yeah, so while we have holds, we don't have any buys right now. We have only holds and quite a few sells. If you would ask me a pecking order in the tier 1 side, I would probably look at buying Tech Mahindra. I think there's going to be a margin mean reversion situation that's going to play out despite revenue growth being weak. That will be my top pick. In the tier 2, I would pick up a BPM player called First Source. those will be the two stocks that would be at the top of my list.
Okay. Tech Mahindra and First Source. Interesting. Thank you so much, Girish, for speaking with us. Always a pleasure.